Welcome. China's latest industrial profit data has just been released, and the headline numbers appear to signal a significant recovery. But the real story is far more complex. Today, we're going to deconstruct that data to uncover the structural forces, policy drivers, and the hidden risks that are truly shaping China's economy.
So let's get straight to our core findings. First, yes, after months of decline, industrial profits have returned to growth. But, and this is crucial, this recovery is extremely fragile. The entire turnaround is being driven by an anomalous surge in a single month, August. What this reveals is a recovery that's narrow, heavily policy-driven, and most importantly, disconnected from actual consumer demand. It's creating a stark, K-shaped divergence across the entire economy.
To really understand what's happening, we need to zoom in on that pivotal month of August. It represents a major turning point, and it holds the key to this entire narrative.
Here's the number that grabbed all the headlines. A massive 20.4% year-over-year increase in industrial profits for August. On the surface, that figure suggests a sudden and powerful economic rebound.
But to really appreciate how dramatic this is, you have to compare it to the month just before. Profits went from a 1.5% decline in July to a 20.4% surge in August. This is, without a doubt, the single most important data point in this release. So the obvious question is, what could possibly drive such a massive turnaround in just 30 days?
Well, this surge wasn't fueled by a fundamental boom in demand. Instead, our analysis points to three very specific factors. First, what's called a base effect. It's being compared to a particularly weak August last year. Second, producer prices improved, which helped repair corporate profit margins. And third, we are seeing the very first impacts of government policies designed to curb destructive price wars.
Now, this policy-driven recovery has not lifted all boats equally. In fact, if you look closer, the data reveals a deep structural split within China's industrial sector. It's truly a tale of two economies operating simultaneously.
And this chart illustrates that divide perfectly. You can see that manufacturing and utilities posted healthy profit growth for the year so far. But in sharp contrast, the mining sector experienced a severe contraction. Profits there fell by over 30%, which is largely a reflection of lower commodity prices compared to the previous year.
We see this exact same split when we analyze the data by ownership type. Private companies have shown more resilience, with profits growing by 3.3%. This is a stark contrast to the state-owned enterprises, which actually saw a 1.7% decline. A big reason for that is their heavy concentration in those underperforming upstream sectors, like mining.
So this divergence we're seeing is a direct result of the core tension in the economy today. It's a strategic push by policymakers to support profitability on the supply side, set against a backdrop of persistent, ongoing weakness on the demand side.
Now, to understand the policy response, you have to understand a key concept that's being discussed in official circles: involution, or Neijian. It describes this kind of destructive, zero-sum internal competition that leads to overcapacity and vicious price wars, a condition the government is now actively trying to manage.
And that focus on involution has led to very direct anti-involution policies. These are targeted, supply-side interventions designed to manage capacity, enforce pricing discipline, and ultimately restore profitability in critical industries that were being hit hard by deflationary pressures.
This brings us to the central contradiction of the current data, which is captured perfectly by this quote. The recovery is fundamentally a supply-side story about repairing profit margins, not a demand-side story driven by strong sales.
And the numbers make this disconnect crystal clear. That 20.4% surge in industrial profits happened in the very same month that retail sales grew by just 3.4%. That enormous gap is the evidence. This rebound is not being fueled by the Chinese consumer.
So, with that critical context in mind, what comes next? Let's turn our attention to the key risks on the horizon and the sectors to watch for the remainder of this year and into the next.
Looking ahead, a timeline of risks becomes pretty clear. In the near term, those favorable base effects that helped boost the August numbers are going to fade, which will likely slow profit growth. Further out, the front-loading of exports we've seen ahead of potential tariffs might also subside. Of course, the largest single risk is the threat of new tariffs in 2026, which could have a significant impact on GDP. And all the while, the core challenge remains persistently weak domestic consumer confidence.
This K-shaped recovery becomes even sharper when we get down to the industry-level data. On one side, you have clear winners in strategic sectors like aerospace and policy-supported areas like non-ferrous metals.
But on the other side, you see deep profit declines in commodity sectors like coal and in industries that are directly tied to the weak property market like furniture manufacturing.
For anyone analyzing this market, these trends really point to three key themes. The first is what we might call policy arbitrage, identifying the national champions who are benefiting from this government-led consolidation. Second is technological sovereignty, pinpointing the firms that are critical to China's push for self-sufficiency. And third is navigating the divergent consumer, understanding the split between resilient essentials and weak property-linked discretionary spending.
So our entire analysis culminates in one forward-looking question. The data shows a clear contest between targeted policy support on the supply side and the fundamental weakness of domestic demand, which is compounded by rising external risks. The critical question for the outlook, then, is which of these powerful forces will ultimately prevail?